Everyone says the silver shortage is over. That's exactly why we're about to see the next leg. Higher, news just dropped. High-grade vein expansion at the Galena Mine. Domestic silver production is getting revised upward. Analysts are quietly adjusting their 2026 supply balance models right now. The headline story? Shortage solved. Silver's done. That's the surface. Here's what's actually happening beneath it. Lease rates are firming instead of collapsing. Retail premiums aren't budging. Warehouse drawdowns are continuing in select vault categories. Commercial hedgers are stepping aside instead of pressing shorts. If you're holding silver, stacking physical, or watching this market for the next entry, this is the signal that separates the group that understands repricing from the group that gets shaken out at the bottom. Your job isn't to predict the top, it's to understand the mechanism that's unfolding right now. And if you're watching this video today, you're ahead of the mainstream narrative by at least 2 weeks. Let's go. Hit subscribe if you're not already locked in. We're the group that reads between the lines. Drop a comment below. Write, "We're early," if you caught this Galena story before it hit CNBC or your favorite finance blog. Here's what happened. Galena Mine announced significant vein expansion, new high-grade silver deposits. Infrastructure's already in place. Near-term production potential is real. This isn't some junior exploration dream 3 years out. This is operational capacity that can scale within quarters. Wall Street's framing it as bearish. More supply equals lower prices, right? That's economics 101. But here's the hidden layer. Despite this supposedly bearish supply news, the subtle signals inside the market are not confirming a bearish outcome. Think about that. If supply is about to flood the market, why aren't premiums collapsing? Why aren't lease rates softening? Why are registered COMEX inventories still flat to down? Why are industrial buyers locking in longer-term contracts instead of waiting for cheaper spot prices? The narrative says one thing. The market structure is whispering something completely different. And when narrative and structure diverge like this, we are usually sitting on a trapdoor moment. The question isn't whether silver goes up or down this week. The question is whether you understand the mechanism that's about to reprice this entire sector. Let me show you the first pattern. I call it narrative flip repricing. Here's how it works. Markets don't always fall when a fear gets resolved. They often rally hard. Why? Because uncertainty is what keeps capital on the sidelines. Once that uncertainty clears, capital doesn't trickle in. It rushes in like a fire hose. Think of it like a pressure valve. For months, sometimes years, investors avoid a sector because there's a structural fear hanging over it. Supply constraints, regulatory risk, geopolitical choke points. Whatever it is, smart money waits. They don't bet until clarity arrives. Then the fear gets resolved, not with a whisper, with a headline. And here's what most people miss. The resolution itself becomes the buy signal, not because the problem was fake, but because the uncertainty that paralyzed decision-making just evaporated. Let me give you a couple examples. Not deep dives, just pattern recognition. Uranium market 2021. Everyone feared supply shortages. New mines weren't coming online fast enough. Then Kazakhstan and Canada announced capacity expansions. Headlines screamed oversupply risk. Uranium didn't collapse, it ripped higher. Why? Because utilities that were sitting on their hands suddenly had certainty that they could secure long-term contracts. Projects that were stalled got greenlit. Demand accelerated faster than supply could ramp. Agricultural commodities after droughts, same pattern. Fear, not enough rain, crop failures, price spike. Resolution, weather normalizes, planting resumes. Headline, surplus incoming. Reality, food manufacturers who delayed purchases flood back in, and prices don't collapse. They stabilize higher because demand was coiled. Circle this. Markets reprice on information flow, not just fundamentals. When a long-running fear dissolves, the flow of capital changes faster than the flow of physical supply. Now, apply that to silver. For 2 years, the narrative has been domestic shortage. Industrial users scrambling, mints paying premiums, delivery delays, investors front-running scarcity. Now, Galena says, we found more. We can produce it, we can do it soon. What happens next? If you only read headlines, you think, sell. But if you understand narrative flip repricing, you think, who was waiting for this clarity? Who can now commit to projects they couldn't justify under shortage conditions? What demand was suppressed because supply certainty didn't exist? That's the fire hose. Not telling you silver rockets tomorrow, showing you the mechanism that historically precedes sharp moves higher after apparent bearish resolutions. Your job is to recognize the structure, not predict exact timing. Could reverse, could chop, but the pattern is live. Here's the second mechanism, and this one compounds with the first. Supply unlock, demand acceleration loop. Here's the setup. When supply is constrained, industrial users ration. They delay projects, they substitute materials, they minimize inventory, they operate in scarcity mode. Then supply expands, new mines, new capacity, new certainty. What happens? You'd think demand stays flat and price falls. But that's not what we see historically. Instead, demand accelerates. Why? Because the gate just opened. Imagine you're a manufacturer. You've been designing a new product that requires silver for conductivity. But you can't launch it because you don't have confidence you can source enough material at stable prices for the next 24 months. So you sit. Now, Galena announces expansion. Analysts revise supply models upward. You're not thinking, great, cheaper silver. You're thinking, finally, I can lock in a contract and launch this project. You call your supplier. You negotiate a multi-year deal. You commit capital. You scale production. Now multiply that across dozens of industrial users, solar panel manufacturers, EV producers, electronics firms, medical device companies. They were all rationing. They were all waiting. Supply certainty doesn't just stabilize demand. It unleashes it. Think of it like a stampede effect. The fence was holding everyone back. Supply expansion opens the gate. Demand doesn't walk through. It runs. And here's the kicker. That demand ramps faster than production ramps. Why? Because production scale-up takes quarters. Contracts get signed in days. Orders get placed in weeks. By the time the new supply actually hits the market in volume, industrial demand has already absorbed the expected increase and is competing for more. Refined availability tightens again. Not immediately, but within months. We've seen this in energy markets. We've seen it in rare earths. We've seen it in agricultural markets after infrastructure investment. The mechanism repeats, and right now, it's setting up in silver, not advice. Pattern recognition. Now here's the part that should make you sit up. The market already knows this. Not the retail crowd, not the headline readers, but the commercial players, the hedgers, the industrial buyers. Look at their behavior. Hedgers aren't pressing shorts. Buyers are locking in longer-term contracts. That's not what you do if you think price is about to collapse. That's what you do if you think the narrative flip is about to trigger the demand acceleration loop and you want to be positioned before it shows up in lagging data. Circle this again. The public story is shortage solved. The private behavior is lock in supply before competition tightens. Which one do you trust? I trust behavior over narrative, every time. Here's what you need to sit with. Everyone's asking the wrong question. They're asking, is the shortage over? That's not the question. The real question is this. What if the shortage was never the real story? What if the real story is the re-rating of silver as a strategic infrastructure metal? Think about it. For decades, silver was treated as a precious metal, a commodity, a store of value, a hedge. But over the last 5 years, something shifted. Solar demand exploded. EV adoption accelerated. Electronics became more sophisticated. Medical applications expanded. Silver stopped being just a monetary metal. It became a critical industrial input. And here's the stakes. When a commodity transitions from nice to have to can't build without, the repricing isn't linear. It's a step function. We saw it with lithium. We saw it with cobalt. We saw it with rare earths. The market doesn't slowly adjust. It gaps. Galena's announcement might not be bearish. It might be the confirmation that silver is now strategic enough to justify major domestic production investment. That's a bullish signal, not a bearish one. And if industrial buyers are interpreting it that way, if they're moving to secure long-term supply instead of waiting for spot price to drop, then the narrative flip is already happening. You're just not seeing it in headlines yet. You're seeing it in lease rates, in premiums, in contract behavior, in warehouse flows. The market is repricing in real time, and the question isn't whether it continues. The question is whether you're positioned to understand it when it accelerates. We'll come back to that. Let's talk scenarios, not predictions. Paths, base case, price chops in a range, higher lows, volatility compresses. Market digests the new supply narrative while industrial demand quietly builds. Premiums stay sticky. Lease rates firm. Registered inventories drift sideways to lower. No explosive move yet. But structure tightens. Bull case. Industrial contracts accelerate faster than expected. Warehouse stocks continue lower despite Galena news. Front-month futures hold above recent breakout zones on pullbacks. Mining equities start outperforming spot silver. That's risk-on confirmation. Capital flows shift. Price enters a fast repricing phase. Could happen in weeks, could take quarters. But the trigger is demand acceleration outpacing supply ramp. Risk case, macro liquidity shock. Fed pivots hawkish. Dollar rips higher. Risk assets get hammered. Silver gets dragged down despite strong fundamentals. Short-term pain. But if the structural story holds, it creates a better entry for those watching closely. Can't know which path. Can only track the signals that tell us which one is unfolding. Here's what I'm watching. Signal 1, front-month silver futures. Normal behavior. Chopping in range, testing support. Holding breakout zones on pullbacks. Stress behavior, breaking below recent support. Failing to reclaim breakouts. Heavy volume selling. What it tells us. Whether capital is still treating this as a breakout or a failed move. Signal 2, retail premiums at major dealers and U.S. Mint. Normal, premiums stay sticky. 10 to 15% above spot, delivery times stable. Stress, premiums collapse toward spot. Inventory floods, delivery times shorten. What it tells us, whether physical demand is still firm or evaporating. If premiums aren't compressing despite more supply headlines, demand is absorbing the narrative. Signal 3, COMEX registered inventories. Normal, flat to slightly down, no major inflows. Stress, sharp drawdowns or sudden large inflows. What it tells us, whether the market is still tight or loosening. If inventories stay flat while supply headlines scream surplus incoming, the tightness is real. Signal 4, mining equities versus spot silver. Normal, miners move in line with spot or slightly outperform. Stress, miners rip higher while spot lags. Risk-on leverage confirmation. What it tells us, whether smart money is betting on sustained higher prices or just trading volatility. Outperformance equals conviction. Signal 5, lease rates and forward curve. Normal, lease rates firm, backwardation starts creeping into short-term contracts. Stress, contango deepens, lease rates collapse. What it tells us, whether holders are willing to lend metal or prefer to hold tight. Backwardation equals shortage expectations despite headlines. These aren't predictions, they're interpretation tools. Your job is to watch them together, not in isolation. If 3 out of 5 are flashing bullish while headlines scream bearish, you're in a narrative flip. If all 5 flip bearish, respect the reversal. Structure over story. Always. Now, let's talk risk. If you're a trader, respect volatility. Don't over-leverage. Don't assume timing. Markets can stay irrational longer than you can stay solvent. If you're a long-term holder, accept pullbacks. Understand you're holding through repricing, not trading headlines. Position size so you can sit through chop without panic selling. If you're stacking physical, recognize premiums can compress in liquidity shocks, even if fundamentals stay strong. Diversify your timing. Don't go all in on one entry. And no matter your approach, know what you own. Understand the mechanism, understand the signals, understand the structure. That's how you stay in the group that doesn't get shaken out at inflection points. Not advice. Your capital, your risk, your responsibility. I'm showing what I'm watching. You decide what fits your strategy. Here's the bottom line. The silver shortage narrative just flipped. Headlines say it's over, but the signals underneath say something different. Lease rates firming, premiums sticky, inventories flat. hedgers stepping aside, buyers locking in contracts. This isn't bearish confirmation. This is narrative flip repricing setting up. This is the supply unlock, demand acceleration loop starting to coil. And if you understand those two mechanisms, you're in the group that sees shifts before they become trends. You're not reacting to headlines. You're reading structure. You're tracking behavior. You're positioned ahead of the crowd that waits for confirmation. That's the edge, not prediction, recognition, and right now, the pattern is live. Could reverse, could chop for months, but the setup is there. If you stay disciplined, watch the signals, and respect the structure, you put yourself in the group that doesn't get blindsided when the repricing accelerates. You're not guessing, you're interpreting. And that's the difference between getting shaken out and staying positioned through the move. So here's what I want you to do. Comment below. Which signal on the watch list are you tracking this week? Premiums, inventories, lease rates? Let's build this together. And if you've ever spotted a market rally on bad news before, if you've seen a narrative flip play out in real time, drop your story in the comments. We learn faster together. Hit subscribe if you haven't already. Hit the bell. We're doing this every week. Signals, patterns, structure, no hype, no predictions, just the mechanisms that repeat. I'll drop links below to tools for tracking COMEX data, premium aggregators, and lease rate sources. Use them, watch them, interpret them, and remember, your job isn't to know what happens next. Your job is to understand how it happens. That's the skill that compounds. That's what separates the group that gets caught off guard from the group that sees it coming. If you're here, you're building that skill. Keep watching, keep learning, keep interpreting. I'll see you in the next one. Stay sharp.